Visa just reported strong growth, but the real story goes beyond the numbers. With rising global spending and cross-border transactions, something bigger is building. Let's break down what investors need to know.
Think about the exact moment you buy a cup of coffee. You tap your phone near the reader, you hear that little satisfying chime, and you just walk away with your latte.
Yeah, it feels incredibly simple.
Right. Instantaneous, even. But underneath that tiny millisecond is this massive, just invisible ocean of data and infrastructure and money just moving at the very edge of the speed of light.
It's honestly kind of mind-boggling when you map it out.
It really is. And today, we actually have our hands on the blueprint of that ocean. We're looking at Visa's official fiscal second quarter 2026 earnings release, which came out on April 28, 2026.
Right, the Q2 numbers.
Yeah, and this isn't just, a scorecard for Wall Street. I mean, an $11.2 billion quarter for a global payment giant that acts as a real-time lie detector test for the global economy.
Oh, absolutely.
It tells us the actual truth about the health of the consumer, the evolution of digital money, and, well, what the future of your wallet actually looks like.
It is the perfect data set for that kind of analysis, to be honest. When you look past the standard corporate formatting and the dense financial tables, you're looking at a real-time barometer of human behavior.
Yeah.
Every single time you tap a card, buy that coffee, or make a cross-border online purchase, you are actively participating in the exact data flow we are about to discuss. Like, you are the data.
Okay, let's unpack this, because to truly understand the broader economic picture here, we have to start with the sheer scale of transactions flowing through this network. I mean, this sets the baseline for everything else.
Break it the raw volume.
Exactly. In just 3 months, so one single quarter, Visa's net revenue hit $11.2 billion. That is a 17% increase, which the CEO, Ryan McInerney, noted was the highest growth since 2022, I think.
Yeah, since 2022. And the profitability isn't lagging behind that revenue growth either.
No, not at all.
Their GAAP net income reached $6.0 billion, which, if you break it down, translates to $3.14 per share.
Yeah.
Yeah, that's an increase of 36% compared to the prior year. And looking specifically at GAAP net income, generally accepted accounting principles.
Right, the standardized stuff.
Exactly. It means we are looking at highly regulated profitability without any creative accounting adjustments. It just shows that the core engine of their business model is incredibly efficient at turning revenue into actual bottom line profit.
Those numbers are astronomical, but honestly, revenue dollars can be a little, abstract when we're talking about global economics.
Sure.
The number that actually stopped me in my tracks was the transaction volume. Total processed transactions for the quarter were a staggering 66.1 billion.
It's a huge number, a 9% increase.
Yeah, 9%. I actually did some back-of-the-napkin math to try and visualize what 66.1 billion transactions actually looks like.
Oh, let's hear it.
It's basically the equivalent of every single person on Earth, like all 8 billion of us, buying roughly 8 items in a single 3-month window.
That is, wow.
Right. Just swiping, tapping, and clicking 8 times for every human alive.
When you frame it that way, the density of the network becomes very clear. And when you look at international movement, it's accelerating even faster. Like cross-border volume, specifically excluding transactions within Europe, increased by 11%.
Wait, why do they specifically single out excluding Europe in the report? I saw that and was a little confused.
Oh, that's because intra-Europe, cross-border transactions are heavily regulated. They're generally lower margin for payment processors.
Okay, that makes sense.
Yeah, so by stripping those out, we get a much clearer picture of high-yield global commerce. Think international travel, heavy cross-border e-commerce, and corporate spending between distant global markets.
I see.
Total cross-border volume was up 12% overall, but that ex-Europe number is the real indicator of global economic velocity.
I have a major pushback on this, though, and I think anyone listening who has been to a grocery store recently is probably wondering the exact same thing.
Okay, what is it?
Well, we all know that the cost of living, the cost of goods, has been climbing over the last few years. So are these massive revenue and volume numbers just like an inflation mirage?
Oh, I see where you're going.
Right, like are revenues up simply because a gallon of milk or an airline ticket costs more right now? Or are consumers actually swiping their cards to buy more physical things?
What's fascinating here is that the earnings report explicitly answers that exact question. And it proves Ryan McInerney isn't just spinning PR when he talks about a resilient consumer.
Okay.
Throughout the document, they repeatedly use a specific metric. They call it a constant dollar basis.
Yes. I saw that plastered everywhere in the tables. How does that actually calculate out?
It's basically a mechanism to strip out the noise of currency fluctuations and inflation so they can look at the raw physical volume of activity.
Okay, so it neutralizes the price tags.
Exactly. They calculate financial measures by using a fixed current year exchange rate for each local currency, and they apply it to both the current and the prior year periods. So, when the report states that processed transactions are up 9% and payments volume is up 9% on a constant dollar basis, they have neutralized the price tags. It means the actual number of times people are transacting, the real physical volume of global commerce, has legitimately grown by 9%.
So people aren't just paying more for less, they are actively participating in the economy at a higher frequency.
They are. The consumer globally is still accelerating their spending behavior.
That's a massive takeaway for anyone tracking the macroeconomy. But okay, so Visa is processing 66 billion transactions and proving the consumer is highly active.
Right.
To handle that kind of volume, the pipes themselves have to evolve. And reading through this report, it becomes incredibly obvious that Visa is no longer just about you swiping a physical piece of plastic at a cash register.
No, not at all. And that brings us to one of the most revealing phrases in the entire release. CEO McInerney described his long-term vision for the company as being the leading hyperscaler of payments globally.
Hyperscaler. I mean, that sounds like a sci-fi term.
It really does.
It's the kind of language you expect from a massive cloud computing giant, not a legacy credit card network.
But that is precisely the architecture they are building. They detail the enhancement of what they call the Visa as a service stack, specifically noting the integration of agentic and stablecoin capabilities.
Agentic meaning AI agents, right?
Exactly. They are building a digital architecture that scales infinitely, just like cloud computing, but specifically designed for the secure movement of value.
Let me make sure I'm visualizing this right. If I think about cloud computing, I think about a startup renting server space from a major tech company to host their app so they don't have to buy their own physical hard drives.
Sure, that's the standard model.
Is Visa as a service essentially the financial equivalent? Like, instead of a new fintech company spending years building bank relationships and security protocols, they just rent an API from Visa and plug directly into their global payment brain.
That's the exact model. They are providing the invisible underlying infrastructure for others to build upon. And if you want to see what that infrastructure looks like in practice, you really have to look at their international expansion.
Oh, right, the Argentina deal.
Yeah, in February 2026, they completed a major acquisition in Argentina, buying two specific companies, Prisma Medios de Pago and NewPay.
Right, and the details of what those two companies actually do is incredibly revealing about Visa's overall strategy.
How so?
Well, Prisma provides credit, debit, and prepaid card issuer processing. But NewPay is described as a multi-network infrastructure provider.
Right.
They operate real-time payment services, the Benelco ATM network, and a massive bill payment platform called Pago Mis Cuentas. Visa isn't just buying a local competitor here. They're buying the actual physical plumbing of Argentina's entire financial system.
Yeah, it's a strategy of creating a closed-loop ecosystem in a highly complex emerging market. I mean, Argentina has historically dealt with intense inflation and a massive need for rapid, secure money movement.
Right, they need alternative rails.
Exactly. By owning the issuance processing through Prisma and the alternative rails like ATMs and real-time transfers through NewPay, Visa embeds itself into every conceivable way value moves in that country.
That makes total sense.
But, your earlier point about stablecoins is really the most critical strategic shift mentioned in the tech stack.
Yes, this is where I have to question the logic of their R&D spending. I'm seeing stablecoins heavily referenced as a growth vector.
Uh-huh.
If Visa's empire, their $11.2 billion quarter, is built almost entirely on traditional fiat currency and legacy banking rails, why are they spending millions to integrate crypto infrastructure?
It seems counterintuitive.
Right. A stablecoin is specifically designed to settle value outside the traditional banking system. Aren't they actively funding the exact technology designed to bypass them?
It looks at cannibalization on the surface for sure.
Yeah.
The Visa strategy here is pure future-proofing.
Future-proof.
Yeah, they understand that the medium of exchange you choose to use in 10 years might look radically different than today. Maybe you use a traditional bank account. Maybe you use a decentralized stablecoin pegged to the dollar.
Oh,
Visa's perspective is entirely agnostic. They don't care what asset you use, as long as they are the network processing the transfer, verifying the fraud, and taking a microscopic fraction of a cent on the movement.
I get it. They want to be the highway, and
Mhm.
they don't care if you're driving a gas car or an electric vehicle.
Exactly. By modernizing their infrastructure in markets like Argentina and aggressively embracing stablecoins, Visa isn't replacing its core network. It is expanding it to become the network of networks.
Oh.
If stablecoins become a dominant method for international settlement, Visa ensures they remain the invisible plumbing underneath those transactions.
So let me get this straight. Visa is spending billions rebuilding the plumbing of emerging markets and investing heavily in crypto and AI architecture. That level of aggressive expansion requires immense capital, which forces us to look at how they are actually managing their war chest.
Right, the balance sheet.
So what does this all mean for the corporate balance sheet?
Well, it means they have immense optionality, and they are using it to aggressively reward their shareholders. The release highlights massive capital returns.
Massive is an understatement.
Yeah, in just this quarter alone, they spent $9.2 billion on share repurchases and dividends.
$9.2 billion returned in 3 months. And then, reading further down the balance sheet, the board of directors authorized a brand new $20.0 billion multi-year share repurchase program.
Yeah, they retired approximately 25 million shares of Class A common stock at an average cost of $320.66 per share.
We see stock buybacks all the time in these earnings reports. How should we actually visualize a $20 billion buyback for a company at this scale?
Think of the total ownership of Visa like a pizza with a set number of slices.
Okay, I like pizza.
When Visa uses its profits to buy back slices from the open market and permanently destroys them, the pizza itself doesn't get smaller.
Right, the company is still the same size.
Exactly. The overall value of the company remains. Instead, the remaining slices instantly become thicker. They represent a mathematically larger percentage of the total pie.
Got it.
By retiring those 25 million shares, Visa is making every single remaining shareholder's piece of the company inherently more valuable without those shareholders having to lift a finger.
But here's where the financial engineering completely lost me, and I have to push back on this balance sheet logic.
Okay, let's hear it.
The report clearly states they ended the quarter with $14.2 billion in cash, cash equivalents, and investment securities. If you have $14.2 billion in liquid cash sitting there, and you were generating record profits, why on earth did Visa go to the debt markets in February 2026 and borrow $3.0 billion in senior notes? Why take on debt when you were swimming in cash?
If we connect this to the bigger picture of corporate finance, it is actually a masterclass in optimizing the cost of capital. You have to look at the terms of that debt.
Okay, where are the terms?
These senior notes have maturities ranging between 3 and 10 years, and the interest rates are locked in from 3.8% to 4.7%.
Which, historically speaking, is incredibly cheap money for a corporation.
It's nearly free money when you factor in inflation and Visa's internal rate of return. If Visa can borrow $3 billion at around 4%, they can leave their actual cash reserves untouched and fully liquid. They can use that cheap borrowed money for general corporate purposes, which the release notes may include refinancing older, more expensive debt, or funding acquisitions like the ones in Argentina.
So it's about leverage.
Exactly. If the AI capabilities or the Argentina expansion yield a return of, say, 15 or 20%, borrowing at 4% to fund it is highly accretive. You never deplete your highly flexible cash reserves if the market is willing to lend you money cheaper than your own cash can earn.
It's the corporate equivalent of taking a low-interest loan to buy an asset you will appreciate massively rather than emptying your own savings account.
Spot on. But managing a balance sheet at this scale isn't just about growth and optimizing debt. It is also about profound defense mechanisms.
Defense mechanisms.
Yeah, and the earnings release contains some fascinating structural details about legal costs that really illustrate how giant corporations insulate themselves.
Oh, I noticed that in the fine print. There was a special item listed.
Mm.
A $311 million litigation provision associated with the interchange multi-district litigation, the MDL case.
Right.
And right below that, a note about depositing $125 million into a litigation escrow account.
Yes. That escrow account was established under the company's U.S. Retrospective Responsibility Plan. The stated purpose is quite literal, actually. It's to insulate the company and its Class A common stockholders from financial liability for certain legacy litigation cases.
Okay, but explain the actual mechanism of that insulation to me. Because as an average person, if I get sued, I just have to pay the damages out of my own pocket.
Right, of course.
How does a company structurally shield its main everyday shareholders from the fallout of a massive multi-district lawsuit?
It requires looking at how Visa was originally formed. Visa used to be a consortium of banks before it went public.
Oh, I didn't know that.
Yeah, and when they structured their initial public offering, they created different classes of shares. The everyday stock that you or I might buy on the open market is Class A. But the original banks hold special, separate classes of shares, primarily Class B.
Okay, so there are different tiers of ownership.
Exactly. When a massive legacy lawsuit hits, like the MDL, which involves merchants suing over historical swipe fees, Visa utilizes that litigation escrow account.
Okay.
When Visa deposits that $125 million into the escrow, the report notes that it has the same economic effect on earnings per share as repurchasing the company's Class A common stock.
Wait, how does putting money into an escrow account act like a stock buyback? That doesn't make sense.
It's because of the Class B shares. The mechanism essentially shrinks the conversion rate or the value of those specific bank-owned Class B shares to fund the penalty.
Oh, wow.
It acts as a structural firewall. The historical risk is absorbed by the legacy share classes, protecting the everyday Class A shares from suddenly plummeting in value when the company has to pay out a penalty. It's a predefined shock absorber built right into their corporate DNA.
That is wild. It really highlights the sheer complexity of operating at a hyperscale level. I mean, you aren't just managing payment rails, you are managing complex legal firewalls, currency fluctuations, and debt markets just to keep the ship moving forward.
It's a massive undertaking.
Which actually brings me to the forward-looking risk factors outlined in the report. Having explored their massive scale, their AI evolution, and their financial dominance, well, what could possibly threaten an economic engine that processes 66 billion transactions a quarter?
If you read the summary of their SEC risk filings included in the release, they paint a picture of an ecosystem under immense constant pressure from three very distinct sides.
Okay, what's the first one?
First, you have the continued industry push by sellers, so the merchants you buy from, to lower acceptance costs. Every store, every online retailer is constantly fighting to pay less to accept a Visa card.
Right, the swipe fees. And second, you have evolving global regulations and government-imposed restrictions on international systems.
Yes.
Governments are increasingly looking for ways to maintain sovereignty over how money moves within their borders, which inherently clashes with a borderless global network.
Exactly. And the third major risk factor is the handling of personal data. The report specifically cites rapid, evolving new laws related to privacy, cybersecurity, and artificial intelligence.
Here's where it gets really interesting to me. Because reading the CEO's opening remarks against the risk factors reveals this massive corporate paradox.
Oh.
Yeah, in the first paragraph, Visa is heavily boasting about rolling out new agentic capabilities, autonomous AI agents, as their primary tool to grow the business and become that hyperscaler.
Right.
But then, in the risk disclosures, they explicitly list AI and the handling of personal data as one of their most significant corporate threats. They are basically building the exact machine they are most terrified of.
This raises an important question about the nature of innovation in the financial sector. The AI tools that allow Visa to process those 66 billion transactions securely, to detect fraud in milliseconds, and to build out Visa as a service. Well, they are entirely dependent on consuming vast amounts of human data.
Yeah, they need the data to learn.
Exactly. The network is essentially training its AI on global spending habits. That capability is beloved by shareholders because it drives efficiency, but it is the exact same capability that draws intense, skeptical scrutiny from regulators globally.
Because the smarter the AI gets at handling and predicting our transaction data, the more nervous governments get about cybersecurity and data privacy.
Impartially speaking, you have an incredibly delicate tug-of-war playing out in real time.
Right.
Visa has a fiduciary mandate to its shareholders to grow, innovate, and maximize the efficiency of the network using tools like AI. Governments have a mandate to protect their citizens' privacy and secure their national financial systems.
And the merchants are caught in the middle.
Yes, fighting to keep their own profit margins from being entirely eaten by the transaction fees required to fund all this innovation.
It is a massive balancing act. And the sheer scale of it is just hard to overstate. Every single time you tap your phone to buy that latte, you are sitting right at the absolute center of that three-way tug of war.
You really are.
You are the resilient consumer keeping the volume up 9%, you are the data point feeding the hyperscale AI, and you are the citizen protected by the data privacy regulations.
You are the single most important variable in that entire $11.2 billion equation. Without the consumer's willingness to tap the glass, the entire infrastructure stops dead.
Which actually brings me to a final, somewhat provocative thought I want to leave you with. Built right off Visa's mention of those agentic capabilities and their goal to hyperscale.
Let's hear it.
If Visa is actively building a digital architecture where autonomous AI agents can execute complex transactions, what happens to the very concept of spending in our daily lives? Imagine a near future where your personal AI assistant autonomously negotiates with a grocery store's AI assistant in the background. It finds the best price, applies your loyalty discounts, and processes the payment seamlessly over Visa's secure network.
Wow, yeah.
What happens to our psychological relationship with money when the network does all the thinking, all the negotiating, and all the actual spending for us, without us ever even pulling a phone out of our pocket or looking at a checkout screen?
The friction of commerce essentially drops to zero. It fundamentally changes what it means to make a purchase when the decision-making process is entirely decoupled from the physical act of paying.
Exactly. The invisible ocean of data gets even deeper, and that little satisfying chime of tapping your card might soon become a nostalgic relic of the past.
It's a wild thought to end on.
Thank you for joining us on this deep dive into the architecture of modern money. Keep questioning the invisible systems that power your daily life, and the next time you buy a coffee, take a second to think about the 66 billion other transactions keeping you company. We'll catch you next time.